Right now, your paycheck lands in your account. Within days, it's gone. You didn't buy anything crazy. No vacations, no new car, just rent, groceries, gas, a few subscriptions you forgot about. And somehow, by the time the next paycheck arrives, you're already counting down the hours until it's gone. You've probably blamed yourself for this. Bad budgeting, bad discipline, too many coffees. But the real reason you're stuck in this cycle is far stranger, and it has almost nothing to do with willpower. It has to do with the order in which your money moves. Here's what almost nobody tells you. Your bank account doesn't know what's important. It just processes transactions in the order they happen. Rent hits first because it's due first. Groceries happen because you're hungry today. Savings, if it happens at all, is whatever's left over at the very end of the month. And there's rarely anything left. This isn't an accident of your personal habits. It's the default architecture of how modern banking was built. Checking accounts were designed in the mid-20th century as pass-through systems. Money comes in, money goes out, and whatever survives, the gauntlet is yours to keep. The economist Richard Thaler spent decades studying exactly this problem. He called it a matter of mental accounting. People don't treat every dollar the same. A dollar sitting in a checking account feels spendable. A dollar automatically moved somewhere else feels untouchable. Thaler's research helped explain why two people with the same income can have wildly different financial outcomes. It's not intelligence. It's not effort. It's sequence. So what if you change the sequence? This is the one shift that breaks the cycle entirely. It's called paying yourself first. Instead of spending first and saving whatever's left, you flip the order. The moment your paycheck arrives, a fixed percentage moves out of reach before you ever see it as spendable money. Sounds almost too simple, doesn't it? But the mechanism behind why it works is where things get interesting. Behavioral economists call this a default setting. Humans are remarkably bad at resisting temptation in the moment, but remarkably good at avoiding decisions we never have to make. If the money is automatically gone before you can spend it, there's no willpower required. There's no daily battle. The decision gets made once, and then it repeats itself forever, invisibly. This is the same principle behind one of the most successful policy experiments in modern economic history. In 2006, the United States passed the Pension Protection Act, which allowed companies to automatically enroll employees into retirement savings plans unless they explicitly opted out. Before this law, employees had to actively choose to save, and most didn't. After automatic enrollment became common, participation rates in retirement plans jumped dramatically, sometimes from under half of eligible workers to well over 80%. Nothing about people's income changed. Nothing about their expenses changed. The only thing that changed was the order of operations. Saving stopped being a choice, made in a moment of willpower, and became a rule set once and then forgotten. You can build this exact system into your own paycheck, right now, without needing a single law or employer to do it for you. Here's how the mechanism works in practice. The moment you get paid, you automatically transfer a fixed percentage, even just 5 or 10%, into a separate account. Not a checking account you can see day to day. A savings account, ideally one that's slightly inconvenient to access. Some people even choose a bank different from the one they use for daily spending, specifically because the extra friction of transferring money back makes withdrawal a genuine decision, not a mindless tap. This is not about depriving yourself. It's about restructuring the sequence so that saving happens before your brain gets the chance to rationalize spending. Why does this particular ordering matter so much? Because of a concept economists call present bias. Humans are wired to value immediate rewards far more than future ones, even when the future reward is objectively larger. A dollar spent today feels more real than a dollar saved for a version of you 5 years from now. This isn't a character flaw, it's a documented, measurable pattern in how the human brain evaluates time and reward. The paycheck-to-paycheck cycle isn't really about how much you earn. Plenty of high earners live exactly this way because their spending simply rises to match their income, a pattern economists call lifestyle inflation. And plenty of modest earners break the cycle completely. Not because they make more, but because they've restructured the order in which their money is allowed to move. Let's make this concrete. Imagine two people earning the exact same salary. One spends throughout the month and saves whatever's left, which is usually nothing. The other automatically saves 10% the moment their paycheck lands. After a year, the first person has whatever emergency savings they scraped together in a good month. The second person has an entire extra paycheck sitting untouched without ever consciously feeling the difference in daily life. Same income, same spending on essentials. Wildly different outcomes purely from timing. This is why banks, credit card companies, and even some employers are not particularly motivated to teach you this shift. A person who saves automatically is a person who carries less revolving debt. Less revolving debt means fewer interest payments. Fewer interest payments means less profit for the institutions that make money on the space between your paychecks. That doesn't mean anyone is conspiring against you specifically. It means the default system was never built with your long-term stability as the priority. It was built to move money efficiently, not to protect your future self from your present self. Once you understand this, the paycheck-to-paycheck cycle stops looking like a personal failure. It starts looking like a design flaw you can simply route around. You don't need a higher salary to escape this trap. You need a different sequence. Move the savings first. Let the spending happen with whatever remains. The bills will still get paid. The groceries will still get bought. But underneath all of it, a small percentage compounds quietly in the background, completely disconnected from your daily willpower. Over months, that small percentage becomes a buffer. Over years, it becomes an emergency fund. Eventually, it becomes the very thing that breaks the cycle for good. Options. The ability to leave a job that isn't working. The ability to weather an unexpected expense without going into debt. The ability, for the first time, to feel like your paycheck belongs to you before it belongs to everyone else. Right now, your paycheck lands in your account. And this time, before it's gone, a piece of it never even had the chance to disappear.